Since the dollar was freed from gold in 1971, it has moved through 4 major bear cycles. Each lasted 6 to 10 years. Each was driven by the same structural trigger: U.S. fiscal expansion outrunning domestic capacity, combined with Federal Reserve policy that ran looser than trading partners. This is the archive. Bear Cycle 1, 1971 to 1978. Nixon ended dollar-gold convertibility in August 1971. The dollar was, for the first time, a fiat currency with no external anchor. The first bear market was immediate. The dollar fell roughly 30% in trade-weighted terms between 1971 and 1978. Oil shocks, Vietnam deficit spending, and the Great Inflation were the forces. The dollar reflected them. The Fed raised rates to emergency levels under Volcker, starting 1979. The dollar reversed sharply. Bear Cycle 2, 1985 to 1992. The Reagan fiscal expansion had driven the dollar to extreme levels. In September 1985, the Plaza Accord committed the G5 nations to a coordinated dollar weakening. The dollar fell roughly 50% in trade-weighted terms between 1985 and 1992. Japanese asset prices collapsed in this environment. The strong yen and monetary tightening set the conditions for Japan's lost decade. The Fed cut rates in 1987 after the Black Monday crash. That loosening contributed to the bear cycle's duration. Bear Cycle 3, 2001 to 2008. After the 90s dollar bull market, the reversal began with the dot-com recession. The Federal Reserve cut rates to 1% in 2003 and held them there for a year. The dollar fell 40% in trade-weighted terms by 2008. That loosening recycled into housing, commodities, and emerging markets. The dollar bear cycle and the commodity supercycle ran together. The 2008 financial crisis triggered a flight to safety. The dollar reversed. Bear Cycle 4. 2020 to present. The COVID fiscal response was the largest peacetime fiscal expansion in U.S. history. The dollar fell from its March 2020 peak through early 2021. Then inflation arrived. The Federal Reserve hiked aggressively in 2022 and 2023. The dollar strengthened. Whether the subsequent softening marks the beginning of a full fourth bear cycle remains an open question in the archive. What all 3 completed cycles share. Each began with U.S. fiscal expansion that outran domestic capacity. Each was accompanied by Federal Reserve policy running looser than major trading partners, or looser than the exchange rate warranted. Each produced capital outflows into the rest of the world. Commodities, emerging markets, and foreign equity all rose in dollar terms during these cycles. Each ended when a policy shock reversed the flow: Volcker rates, the Plaza Accord, or the global financial crisis. The dollar remains the global reserve currency. Prior bear cycles ran within that constraint, not against it. This is market memory.